Hello and welcome. We're about to embark on a journey together. A journey designed to demystify one of the most important, and often most intimidating, subjects in our lives, personal finance. For the next several chapters, we will be exploring and answering the top financial questions that people all across the United States ask every single day. Whether you're just starting your career, raising a family, or planning for your future, our goal is to provide clear, accessible information to help you build a stronger financial foundation. Before we dive into our very first topic, it is absolutely essential to start with a very important disclaimer. The information provided in this entire series is for educational and informational purposes only. It is not intended to be, and should not be interpreted as financial, investment, legal, or tax advice. Personal finance is deeply unique to every individual. Your circumstances, your goals, and your risk tolerance are specific to you. Therefore, we strongly encourage you to consult with a qualified professional, such as a certified financial planner, a licensed accountant, or an attorney, before making any financial decisions. Our mission here is to empower you with knowledge so you can ask the right questions and have more informed conversations with those experts and for yourself. With that said, let's begin with the most fundamental question of all. It's the question that is often the biggest hurdle. I want to get my finances in order. Where do I even begin? This feeling of being overwhelmed is completely normal. The world of finance is filled with jargon, complex products, and what seems like a million different opinions. The key is to ignore the noise and start with two simple, yet powerful steps. Understanding what you have, and understanding where it goes. The first step is to create a complete and honest snapshot of your current financial situation. This is often referred to as calculating your net worth. It's a simple formula. What you own minus what you owe. Let's break that down. What you own are your assets. This includes things like the cash in your checking and savings accounts, the value of your retirement accounts like a 401k or an IRA, the current market value of your home if you're a homeowner, the value of your car, and any significant investments you might have in stocks or mutual funds. Make a list of all your assets and their current estimated value. Next is what you owe. These are your liabilities. This side of the equation includes your mortgage balance, any outstanding student loan debt, your credit card balances, car loans, personal loans, and any other money you owe to others. Be thorough and list every single debt and the total amount outstanding. Now you subtract your total liabilities from your total assets. The number you get is your net worth. This number is not a judgment of your self-worth. It is simply a starting point. It is your financial baseline. Whether it's positive or negative, knowing this number is the first step toward taking control. It gives you a clear picture of your financial health, much like a doctor taking your blood pressure before making a diagnosis. You will track this number over time, perhaps once or twice a year, to see your progress. Once you know where you stand, the second foundational step is to understand your cash flow. In simpler terms, tracking where your money comes from and where it goes. This is the essence of budgeting. The word budget can make people cringe. It often sounds like a restrictive diet for your wallet. But a better way to think about it is as a spending plan. It's a tool that gives you freedom, not restriction. It's about consciously telling your money where to go, instead of wondering where it went at the end of the month. To start, you need to track every dollar for a period of time, usually 1 to 2 months, to get an accurate picture. There are many ways to do this. Some people prefer a simple notebook and pen. Others use a spreadsheet on their computer. And of course, there are countless budgeting apps and software available today that can link to your bank accounts and automatically categorize your spending for you. The method doesn't matter as much as the consistency. Your spending generally falls into 3 categories. First, you have your fixed expenses. These are the costs that are roughly the same every month, like your rent or mortgage payment, car payment, insurance premiums, and subscription services. Second, you have your variable expenses. These are necessities that can fluctuate each month. This category includes groceries, gasoline for your car, utilities like electricity and water, and household supplies. Third, you have discretionary spending, which is often referred to as wants. This includes things like dining out, entertainment, shopping for non-essentials, hobbies, and travel. Once you have a clear picture of your income and your expenses, you can start making a plan. A very popular and easy-to-understand guideline for creating a spending plan is the 50/30/20 rule. This is not a strict law, but rather a helpful framework. Under this guideline, you would aim to allocate 50% of your after-tax income to your needs. This covers all your essential living expenses, your housing, transportation, utilities, and groceries. These are the things you absolutely must pay to live. The next 30% is allocated to your wants. This is the discretionary spending category we just discussed. It's the money for your lifestyle, for the things that bring you joy, like that concert ticket, the weekend trip, or dinner with friends. Finally, and most importantly, the remaining 20% is for savings and debt repayment. This is the portion of your income that works for your future self. This includes building an emergency fund, contributing to your retirement accounts, saving for a down payment on a house, or aggressively paying down high-interest debt like credit cards. If you have significant high-interest debt, many financial experts would suggest allocating a larger portion of this 20%, or even more, towards paying that down as quickly as possible. These two exercises, calculating your net worth and creating a spending plan, are the bedrock of financial management. They give you clarity and control. They transform money from a source of stress into a tool that you can use to build the life you want. This process isn't just about numbers on a page. It's about aligning your financial habits with your personal values and long-term goals. So, to recap Chapter 1, the answer to the question, where do I begin? Is to start with a clear, honest assessment. First, calculate your net worth by subtracting what you owe from what you own. Second, track your income and expenses to create a spending plan, or budget, that works for you. These steps provide the map you need for the rest of your financial journey. In our next chapter, we will build directly on this foundation. Now that we understand our financial picture, we'll tackle one of the biggest sources of financial stress, debt. We will explore the different types of debt and discuss common strategies for managing it and paying it off effectively. Thank you for joining me. Welcome back. In our first chapter, we laid the essential groundwork for our financial journey by learning how to get a clear and honest picture of our finances. We talked about calculating your net worth and the importance of creating a spending plan. Now, with that foundation in place, we're ready to tackle one of the most significant financial topics for millions of Americans: debt. Debt can feel like a heavy weight, and it's a subject that often brings with it feelings of stress and anxiety. But our goal in this chapter is to reframe how we look at debt. Instead of seeing it as an insurmountable obstacle, we're going to view it as a manageable challenge that, with the right knowledge and a clear strategy, you can overcome. Before we dive into strategies for paying it off, it's helpful to understand that not all debt is created equal. Financial educators often place debt into two broad categories: good debt and bad debt. Now, these terms are just general labels, but they help illustrate a concept. Good debt is typically debt that is used to purchase something that has the potential to increase in value or increase your earning potential over time. Think of it as an investment in yourself or your future. The most common examples are a mortgage to buy a home, which can appreciate in value, or student loans, which can lead to a higher-paying career. While these are considered good, they are still serious financial obligations that must be managed responsibly. On the other hand, bad debt, sometimes called unproductive debt, is typically used to finance consumer goods or experiences that depreciate in value or are consumed immediately. The most common example is high-interest credit card debt used for non-essential purchases. This type of debt often carries very high interest rates and can grow quickly if not managed carefully, making it a significant drain on your financial resources. Understanding the difference can help you prioritize which debts to focus on most aggressively. So you've reviewed your spending plan from Chapter 1, and you've identified an amount of money you can consistently put toward paying down your debts each month, beyond the minimum payments. The question now is, where should that extra money go? There are two very popular and widely discussed strategies for tackling debt repayment. It's important to understand both, as the best one often depends on your personal psychology and what keeps you motivated. These are commonly known as the debt snowball and the debt avalanche methods. Let's look at the debt snowball first. With this method, you list all of your debts from the smallest balance to the largest, regardless of the interest rate. You continue to make the minimum required payment on all of your debts. Then, you take all the extra money you have allocated for debt repayment and throw it at the debt with the smallest balance. Once that smallest debt is completely paid off, you celebrate that win. Then you take the entire amount you were paying on that debt, the minimum payment plus all the extra money, and roll it over to the next smallest debt on your list. You repeat this process, creating a snowball of payments that grows larger and larger as it rolls down the hill, knocking out each debt one by one. The primary advantage of the debt snowball is psychological. Paying off that first, small debt can provide a huge motivational boost. It feels like a quick win, and can give you the encouragement you need to stick with your plan for the long haul. Now let's explore the debt avalanche method. With this strategy, you list your debts in order of their interest rate, from the highest interest rate down to the lowest, regardless of the balance. Again, you make the minimum payments on all debts to stay in good standing. Then you focus all of your extra payment money on the debt with the highest interest rate. Once that debt is paid off, you take all the money you were paying towards it and apply it to the debt with the next highest interest rate. The main advantage of the debt avalanche is mathematical. By targeting your highest interest debt first, you will pay less in total interest over the life of your loans. From a purely financial standpoint, this method can save you money. The potential downside is that it might take longer to pay off your first debt if it has a large balance, which could be discouraging for some people. So which one is right? There is no single correct answer. It's a personal choice. Some people are motivated by seeing balances disappear quickly, making the snowball method a great fit. Others are motivated by knowing they are making the most financially optimal choice, which makes the avalanche method more appealing. The most effective strategy is the one that you will actually stick with consistently until you are debt-free. Regardless of the method you lean towards, one rule is non-negotiable. You must always make at least the minimum payment on every single one of your debts, and you must make them on time. Missing payments can result in late fees and can negatively impact your credit score, which is a crucial component of your overall financial health. As you explore your options, you may also come across the idea of debt consolidation. This involves taking out a new, single loan to pay off multiple other debts. The goal is often to simplify your payments into one monthly bill and, ideally, to secure a lower overall interest rate. This can be done through a personal loan or a home equity loan, for example. While this can be a useful tool for some, it's critical to research the terms, including any fees and the new interest rate, and to be disciplined enough not to run up new balances on the accounts you just paid off. This is a significant financial decision that warrants careful consideration. To recap our chapter on debt, it's a challenge that can be managed with a clear plan. Start by understanding the types of debt you have. Then, explore repayment strategies like the debt snowball for psychological motivation or the debt avalanche for mathematical efficiency, and consider which approach best fits your personality. Now that we have a plan for managing what we owe, our next chapter will focus on building for the future. We'll discuss the critical importance of saving, starting with the number one financial safety net everyone should have, an emergency fund. Thank you for listening. Hello and welcome back. In our previous chapters, we established our financial baseline and discussed strategies for managing debt. We've been clearing the path. Now, it's time to build the single most important defensive tool in your financial toolkit, the emergency fund. Life is unpredictable. A car can break down, a roof can leak, an unexpected medical bill can arrive in the mail, or a sudden job loss can turn your world upside down. These events are not just inconvenient. They can be financially devastating if you're not prepared. An emergency fund is your private financial safety net. It's a readily available pool of cash set aside for one purpose only: to help you navigate major, unexpected expenses without derailing your long-term financial goals or forcing you into high-interest debt. Think of it as a financial shock absorber. When you hit a bump in the road, the emergency fund cushions the impact, allowing you to handle the situation and continue moving forward. Without it, a common response is to turn to credit cards or high-interest loans, which can start a debt cycle that is difficult to break. So, what exactly counts as an emergency? This is a key question. An emergency fund is generally intended for true, unforeseen crises. This includes things like loss of your primary source of income, urgent medical or dental expenses not covered by insurance, essential home repairs like a broken furnace in winter, or major car repairs that you need to get to work. It's equally important to understand what an emergency fund is not for. It's not for a down payment on a car, a vacation, holiday gifts, or a new television. Those are planned expenses that should be saved for separately. The discipline to use this fund only for true emergencies is what gives it its power. This leads to the most common question people ask: how much money do I actually need in my emergency fund? While there is no magic number that fits everyone, a widely cited benchmark from financial professionals is to save between 3 to 6 months' worth of essential living expenses. Let's be very clear. This is a guideline, not a rigid rule. The right amount for you depends entirely on your personal circumstances. To figure out your number, look back at the budget or spending plan you created in Chapter 1. Add up all your absolute must-have expenses for 1 month. This includes your rent or mortgage, utilities, food, transportation, insurance premiums, and minimum debt payments. This is the amount you need to simply keep your life running. Now multiply that number by 3, and then by 6. That range is your target. Whether you should aim for the lower end or the higher end of that range depends on your stability. For instance, if you are in a two-income household and both you and your partner have very stable jobs in high-demand fields, you might feel comfortable closer to the 3-month end. However, if you are a single-income household, a freelancer with fluctuating income, or work in an industry with less job security, aiming for 6 months, or even more, provides a much larger cushion and greater peace of mind. The idea of saving 6 months of expenses can feel incredibly daunting, especially if you're just starting. So the key is to start small. Many people aim for a starter emergency fund first. This might be a goal of $500, $1,000, or 1 month's rent. The goal is to get something in place as quickly as possible. This smaller fund can prevent a minor inconvenience from turning into a major debt. Once you hit that initial goal, you can continue building it over time toward your larger 3 to 6 month target. The next logical question is, where should I keep this money? The location of your emergency fund is just as important as the amount. The money needs to satisfy 3 key criteria. It must be safe, it must be separate, and it must be accessible. First, safe means the money should not be invested in the stock market or anything else where its value could go down. The principal amount needs to be protected. You want to be sure that if you put $1,000 in, $1,000 will be there when you need it. This is why people often use savings accounts at banks insured by the FDIC or credit unions insured by the NCUA. Second, separate. It is highly recommended to keep your emergency fund in an account that is separate from your everyday checking account. When the money is out of sight, it's out of mind. This separation creates a psychological barrier that makes you less likely to dip into it for non-emergency reasons. Third, accessible or liquid. While you don't want the money to be too easy to access, you do need to be able to get to it relatively quickly in a real emergency. You shouldn't have to wait a week or pay penalties to get your cash. For these reasons, many people choose to keep their emergency fund in a high-yield savings account. These accounts are typically offered by online banks, are FDIC insured, are separate from a primary checking account, and often provide a slightly higher interest rate than a traditional brick-and-mortar savings account, allowing your money to grow a little while it sits. A money market account is another common option that shares similar features. The specific product is less important than making sure it meets the criteria of being safe and liquid. Building this fund takes time and discipline. The most effective way to build it is to make it automatic. Decide on an amount you can afford to save from each paycheck, even if it's small, and set up an automatic transfer from your checking account to your separate emergency savings account. By paying yourself first, you prioritize your financial security without having to think about it. In summary, an emergency fund is the non-negotiable foundation of financial security. It protects you and your future goals from life's inevitable surprises. Start by defining a target, typically 3 to 6 months of essential expenses, and begin building toward it, even with small, automated contributions. With a safety net in place, we can begin to shift our focus from defense to offense. In our next chapter, we will look further into the future and demystify the world of retirement savings. We'll discuss why it's so important to start early, and explore the common types of retirement accounts available in the United States. Thank you for joining me. Hello and welcome back. In our last chapter, we built our financial defense by focusing on the importance of an emergency fund. With that safety net in place, we can now confidently shift our focus from short-term security to long-term prosperity. Today, we are going to talk about one of the most significant financial goals for most Americans: planning for retirement. Retirement might feel like a distant concept, especially if you're in your 20s or 30s. It's easy to think, I'll worry about that later. But the single most powerful tool you have on your side when it comes to retirement saving is time. This is because of a concept that has been called the eighth wonder of the world: compound growth. Compound growth, or compounding, is the process where your investment earnings begin to generate their own earnings. Let's imagine a simple, hypothetical example purely for illustration. Say you put some money into an account, and in the first year, it earns a return. The next year, you earn a return not just on your original money, but also on the earnings from the first year. Over many years and decades, this effect can be incredibly powerful, causing your savings to grow at an accelerating rate. The earlier you start, the more time your money has to work for you. It is the #1 reason why starting to save for retirement, even with very small amounts, as early as possible is so critical. Of course, it's important to remember that investment returns are never guaranteed and can fluctuate. To help people save for retirement, The US government has created special types of accounts that offer tax advantages. It's helpful to think of these accounts not as investments themselves, but as special containers, or baskets, that you put your investments into. These containers have special rules and tax benefits designed to encourage long-term saving. The two most common categories of retirement accounts are employer-sponsored plans and individual retirement accounts, or IRAs. Let's start with employer-sponsored plans. The most well-known of these is the 401k. If you work for a nonprofit organization or a school, you might have a similar plan called a 403b. These are retirement savings plans offered by an employer as a benefit to their employees. One of the great features of these plans is that contributions can be made automatically, directly from your paycheck. This pay-yourself-first approach makes saving consistent and effortless. But perhaps the most valuable feature of many employer-sponsored plans is the company match. An employer match means that if you contribute a certain percentage of your salary to your 401k, your employer will contribute money on your behalf as well, up to a certain limit. For example, a common match is 50% of the first 6% of your salary. This means if you contribute 6% of your pay, your employer will add an extra 3%. This is essentially a 50% return on your money, instantly. For this reason, many financial experts suggest that, if possible, you should contribute at least enough to your 401k to get the full employer match. Not doing so is like turning down a portion of your compensation package. The second major category is the individual retirement account, or IRA. As the name suggests, you open an IRA on your own, and it is not tied to any specific employer. This makes it a great option for everyone, including self-employed individuals, or those whose jobs don't offer a retirement plan. There are two primary types of IRAs, and the main difference between them is how they are taxed. This is a very important concept to understand. First, there is the traditional IRA. With a traditional IRA, your contributions may be tax deductible in the year you make them, depending on your income and whether you have a retirement plan at work. This means it could lower your taxable income today. Your investments then grow tax-deferred, meaning you don't pay taxes on the growth each year. You will, however, pay ordinary income tax on all the money you withdraw when you take it out in retirement. Second, there is the Roth IRA. The Roth IRA works in the opposite way. Your contributions are made with money you've already paid taxes on. They are not tax-deductible. However, your investments grow completely tax-free. Then, when you take qualified withdrawals in retirement, you pay no income tax at all. The growth and the withdrawals are tax-free. So which one is the better choice? A traditional or a Roth? There is no single answer that applies to everyone. The decision often hinges on whether you believe your income tax rate will be higher now, while you are working, or later in retirement. The choice has significant tax implications. For this reason, this is an area where consulting with a qualified tax professional or financial advisor can be particularly valuable. They can help you understand the rules and evaluate which type of account might align better with your personal financial situation. It's also important to know that these accounts, 401ks and IRAs, are just the containers. Inside them, you will choose from a variety of investment options, such as mutual funds, index funds, and bonds, to actually grow your money. We will explore the basics of investing in a future chapter. To summarize this chapter, saving for retirement is a long-term goal made much easier by the power of compound growth. Take advantage of tax-advantaged retirement accounts to help you save. If your employer offers a 401k with a match, it's often a great place to start. And IRAs, in both traditional and Roth versions, are powerful tools available to almost everyone. Now that we're thinking about building for the long term, our next chapter will focus on another critical long-term number that profoundly impacts your financial life: your credit score. We'll explore what it is, why it matters, and the factors that influence it. Thank you for listening. Hello and welcome back. In our journey so far, we have built a financial foundation, created a plan for debt, established a safety net, and looked ahead toward retirement. Now, we're going to turn our attention to a 3-digit number that has a powerful influence over your financial life: your credit score. What is a credit score? In simple terms, it's like a financial report card. It's a number, typically ranging from 300 to 850, that represents a snapshot of your creditworthiness at a single point in time. Lenders and other institutions use this score to quickly assess the risk of lending money or providing a service to you. A higher score generally indicates a lower risk, while a lower score suggests a higher risk. But why does this number matter so much? Your credit score can impact your life in ways you might not expect. The most obvious is in borrowing money. When you apply for a mortgage to buy a home, a loan to buy a car, or even a new credit card, lenders will look at your credit score. It not only determines whether you get approved but also, and just as importantly, what interest rate you will pay. A higher credit score can often qualify you for a lower interest rate, which can save you thousands or even tens of thousands of dollars over the life of a loan. A lower score, on the other hand, may result in a much higher interest rate, making borrowing significantly more expensive. Beyond lending, your credit history can also be a factor when you try to rent an apartment, set up utility services for your home without a security deposit, or even get certain types of insurance. For these reasons, understanding and managing your credit is a cornerstone of good financial health. To understand your score, you need to understand what goes into it. While there are a few different scoring models, the most widely used are FICO scores. These scores are calculated using information from your credit reports, which are maintained by the three major credit bureaus: Equifax, Experian, and TransUnion. The calculation is based on 5 main factors, each with a different level of importance. The single most important factor, making up about 35% of a typical FICO score, is your payment history. This is a record of whether you have paid your past credit accounts on time. A consistent history of on-time payments will have a positive impact on your score. Conversely, late payments, missed payments, or having accounts sent to collections can have a significant negative impact. The second most influential factor is amounts owed, which accounts for about 30% of your score. This category looks at how much debt you are carrying. A key part of this is your credit utilization ratio. This ratio primarily applies to revolving credit like credit cards, and is the percentage of your available credit that you are currently using. For example, if you have one credit card with a $10,000 limit and a balance of $3,000, your utilization is 30%. A lower credit utilization ratio is generally viewed more favorably by scoring models. Many financial experts suggest keeping this ratio below 30%, but this is a general guideline. Next, making up about 15% of your score, is the length of your credit history. This factor considers the age of your oldest credit account, your newest account, and the average age of all your accounts. A longer history of responsible credit management is generally a positive signal. The fourth factor is your credit mix, which accounts for about 10% of the score. Lenders and scoring models generally like to see that you can responsibly manage different types of credit. This includes both revolving credit, like credit cards, and installment loans, like a mortgage or an auto loan, which have a fixed number of payments. This does not mean you should open new accounts just for the sake of having a mix. This is simply one piece of the overall puzzle. Finally, the last 10% is related to new credit. This factor looks at how many new accounts you have recently opened and how many hard inquiries are on your report. A hard inquiry occurs when a potential lender checks your credit after you've applied for new credit. Opening several new credit accounts in a short period can represent a greater risk and may temporarily lower your score. So, how do you keep track of all this? Under U.S. law, you are entitled to a free copy of your credit report from each of the 3 major credit bureaus, once every 12 months. The official, federally authorized source to get these reports is annualcreditreport.com. It is a valuable habit to review these reports regularly to ensure all the information is accurate, and to look for any signs of fraudulent activity. Note that these reports will show your detailed history, but they usually do not show your 3-digit credit score, which is often sold separately or provided as a free service by many credit card companies and banks. Behaviors that tend to have a positive influence on credit scores over time include consistently paying all bills on time, keeping credit card balances low, and avoiding applying for too much new credit in a short span of time. It's a marathon, not a sprint. In summary, your credit score is a vital financial tool that reflects your reputation as a borrower. By understanding the 5 key factors that shape it: payment history, amounts owed, length of history, credit mix, and new credit, you can better understand your own financial habits and how they are perceived. With a strong understanding of our financial health and reputation, we are now ready to explore how to put our money to work. In the next chapter, we will take our first steps into the world of investing, breaking down the fundamental concepts and key terminology to demystify the process. Thank you for listening. Hello and welcome back. In our journey so far, we have built a solid financial house. We have a foundation of budgeting, a plan for our debts, a safety net with our emergency fund.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
A framework for retirement, and an understanding of our credit score. Now, with those protections in place, we can explore the topic of putting our money to work. Investing. The world of investing can seem complex and intimidating, filled with jargon and fast-moving charts. Our goal today is not to tell you where or how to invest. Instead, our goal is to demystify the language of investing and introduce you to the core concepts. This chapter is designed to be a vocabulary lesson, giving you the tools to understand the conversation. Before we proceed, it is crucial to restate our most important message. This information is for educational purposes only and is not investment advice. Investing involves risk, including the potential loss of the money you invest. The financial markets can be volatile. Any decision to invest should be made carefully and, ideally, in consultation with a qualified and licensed financial advisor who can understand your personal situation and goals. First, let's clarify the difference between saving and investing. Saving is typically for short-term goals and capital preservation. The money you put in your emergency fund is saved. Its primary job is to be safe and accessible. Investing, on the other hand, is generally for long-term goals like retirement, which is 5 years or more away. The primary goal of investing is to grow your money at a rate that, hopefully, outpaces inflation, so your money has more purchasing power in the future. The most fundamental concept in all of investing is the relationship between risk and potential return. This is a foundational principle. In general, investments that have the potential for higher returns also come with a higher level of risk. Conversely, investments that are considered lower risk typically offer lower potential returns. There is no such thing as a high return, no risk investment. Understanding your own personal comfort level with risk, often called your risk tolerance, is a key part of developing any long-term financial strategy. So, what are the basic building blocks of the investment world? Let's cover the main asset classes. The first is stocks, also known as equities. When you buy a share of a stock, you are buying a small piece of ownership in a publicly traded company. If that company performs well, its profits grow and its future looks bright. The value of your ownership share may increase. If the company performs poorly, the value of your share may decrease. Some companies also distribute a portion of their profits to shareholders in the form of payments called dividends. Stocks are generally considered to be on the higher end of the risk and return spectrum. The second major asset class is bonds, also known as fixed income. When you buy a bond, you are essentially lending money to an entity, which could be a corporation or a government, like the U.S. Treasury. In exchange for your loan, the issuer promises to pay you periodic interest payments over a set term. At the end of that term, when the bond matures, the issuer returns your original investment, the principal. Generally speaking, bonds are considered less risky than stocks, but they also have historically offered lower long-term returns. While you can buy individual stocks and bonds, many people choose to invest through pooled funds, which allow them to own a wide variety of investments all at once. The two most common types are mutual funds and exchange-traded funds. A mutual fund is a professionally managed portfolio that pools money from many investors to purchase a collection of stocks, bonds, or other assets. When you invest in a mutual fund, you are buying shares of the fund itself, and you indirectly own all the different investments inside it. A specific type of mutual fund that has become very popular is the index fund. An index fund aims to track and replicate the performance of a specific market index, such as the S&P 500, which represents 500 of the largest U.S. companies. Instead of having a manager actively picking and choosing which investments to buy, an index fund simply buys and holds the investments that are in the index it tracks. Because of this passive management style, index funds are often known for having lower operating fees compared to actively managed funds. Finally, there are exchange-traded funds, or ETFs. Like mutual funds, ETFs also hold a basket of assets like stocks or bonds. A key difference is that ETFs trade on a stock exchange throughout the day, just like an individual stock, and their prices can fluctuate minute by minute. This brings us to our final core concept for today, diversification. You've likely heard the old saying, "Don't put all your eggs in one basket." That is the essence of diversification. It is a strategy designed to manage risk by spreading your investments across different asset classes, industries, and geographic regions. The idea is that if one part of your investment portfolio is performing poorly, other parts may be performing well, which can help to smooth out the overall returns. It's important to understand that diversification does not guarantee a profit or protect against loss in a declining market. but it is a widely recognized principle for managing investment risk. In summary, investing is a long-term strategy for growing your wealth. It revolves around the core concepts of risk and potential return. The basic building blocks include stocks and bonds, which can be owned individually or through pooled vehicles like mutual funds and ETFs. And diversification is a key strategy for managing risk. Now that we have a basic vocabulary for investing, we can start to see how these tools are used to achieve major life goals. In our next chapter, we will tackle one of the biggest financial milestones for many Americans: the process of planning and saving for a home. Thank you for listening. Hello and welcome back. In our last chapter, we dipped our toes into the world of investing, learning the basic vocabulary that powers long-term growth. Today we're going to focus on one of the biggest financial and personal milestones that many Americans strive for, a goal where all of our previous topics, budgeting, debt, credit, and saving, come together: buying a home. Homeownership can be a powerful tool for building long-term wealth and a deep source of personal pride and stability. However, it's also one of the largest financial commitments you will ever make. It's a decision that requires careful planning and a clear understanding of all the costs involved. Our goal in this chapter is to walk through the key financial considerations so you can approach this goal with confidence. The first step is to understand the true cost of buying a home, which goes far beyond the sticker price you see on a real estate listing. There are three main categories of costs to prepare for: the initial upfront costs, the closing costs, and the ongoing costs of ownership. Let's start with the most well-known upfront cost, the down payment. This is the portion of the home's purchase price that you pay out of pocket at the time of the sale. The rest of the price is typically covered by a loan from a bank or mortgage lender. You may have heard the common guideline that you need a 20% down payment. For example, on a $300,000 home, that would be $60,000. Putting down 20% is a significant financial goal, and achieving it has a major benefit. It typically allows you to avoid paying for private mortgage insurance, or PMI. PMI is a type of insurance that protects the lender, not you, in case you are unable to make your mortgage payments. It's an extra monthly cost added to your mortgage payment. However, it's a common misconception that you must have 20% to buy a home. There are many different loan programs available in the United States, including FHA loans and conventional loans, that allow for down payments as low as 3 to 5%. While these programs make homeownership more accessible, they usually require you to pay for mortgage insurance, increasing your monthly payment. Next up are the closing costs. These are the fees you pay to all the professionals who help finalize the real estate transaction. This can include fees for the loan origination, the home appraisal, the title search and insurance, legal services, and more. As a general rule of thumb, you can expect closing costs to be anywhere from 2 to 5% of the total loan amount. So, on that same $300,000 home, you would need to plan for an additional $6,000 to $15,000 in cash, separate from your down payment. Finally, and perhaps most importantly, you need to plan for the ongoing costs of homeownership. Your monthly mortgage payment is often referred to by the acronym PITI. This stands for principal, interest, taxes, and insurance. Principal is the portion of your payment that goes toward paying down the actual loan balance. Interest is the fee you pay to the lender for borrowing the money. Taxes refer to the annual property taxes you'll pay to your local government, which are often collected by the lender and paid on your behalf. And insurance is for your homeowner's policy, which protects your home against damage from things like fire or storms. But PITI is just the beginning. You also have to budget for maintenance and repairs. When you're a homeowner, there is no landlord to call when the water heater breaks or the dishwasher stops working. A common guideline is to budget about 1% of your home's value for annual maintenance. On a $300,000 home, that would be $3,000 per year, or $250 per month, set aside for these expected and unexpected repairs. Additionally, some homes are part of a homeowners association, or HOA, which comes with its own monthly or annual fees. So, how do you prepare for such a large purchase? Lenders will look closely at two key financial metrics. First, as we discussed in Chapter 5, is your credit score. A strong credit score is critical for getting approved for a mortgage and for securing a lower interest rate. Second, lenders will analyze your debt-to-income ratio, or DTI. This is a percentage calculated by dividing your total monthly debt payments, including your potential new mortgage payment, by your gross monthly income. This ratio helps lenders assess your ability to manage your monthly payments and repay the money you plan to borrow. The process of getting a mortgage typically begins with getting pre-qualified or pre-approved. A pre-approval is a more formal process where a lender reviews your financial documents and determines how much they are willing to lend you. This is a crucial step that shows sellers you are a serious buyer. When you do apply, you'll find there are different types of mortgages, with the most common being the fixed-rate mortgage, where the interest rate stays the same for the entire loan term, and the adjustable-rate mortgage, ARM, where the interest rate can change after an initial fixed period. The choice between them has long-term financial implications and is worth researching thoroughly. In summary, buying a home is a significant and rewarding goal. Success lies in preparation. This means understanding and saving for both the down payment and closing costs, having a realistic budget for the ongoing costs of ownership, and working to maintain a strong credit score and a healthy debt-to-income ratio. Now that we've discussed protecting one of your biggest potential assets, a home, let's broaden the conversation to protecting your most important asset, you and your financial well-being. In our next chapter, we will demystify the world of insurance. Thank you for listening. Hello and welcome back. Throughout this series, we have been focusing on building a strong financial future by budgeting, managing debt, saving, and investing. But a crucial part of any strong structure is its defense system. How do you protect everything you've worked so hard to build from a sudden, catastrophic event? The answer lies in understanding the role of insurance. Insurance can seem like a complex topic, but at its core, it's a simple concept: managing risk. It is a tool that allows you to transfer the risk of a very large, potentially devastating financial loss to an insurance company. In exchange, you pay a smaller, predictable fee called a premium. It's a financial safety net designed to protect you, your family, and your assets when the unexpected happens. Think of it not as an investment to make you money, but as a shield to prevent you from losing everything. Before we explore the different types of insurance, let's quickly define a few key terms you will encounter. A premium is the regular payment, either monthly or annually, that you make to keep your insurance policy active. A deductible is the amount of money you must pay out of pocket for a covered event before the insurance company starts to pay. Coverage refers to the scope and amount of protection provided under an insurance policy. And a claim is the formal request you file with the insurance company to receive payment after an incident. Now, let's look at the major types of insurance that form the pillars of a personal financial protection plan. First is health insurance. In the United States, health insurance is essential, as medical costs can be extraordinarily high. Its purpose is to help cover the costs of medical care, from routine doctor visits to major surgeries and hospital stays. Most Americans get health insurance through their employer, but it can also be purchased through government marketplaces or directly from insurance companies. You'll often hear terms like HMO, Health Maintenance Organization, and PPO, Preferred Provider Organization. These are different types of plans that have different structures regarding how you can access doctors and specialists. The specifics of health insurance plans can be complex, and it's important to review the details of any plan to understand its network of doctors, deductibles, and out-of-pocket costs. Next is auto insurance. If you own and drive a car, having auto insurance is not just a good idea. It's required by law in nearly every state. Its primary purpose is to provide financial protection in case of an accident. The most basic form of coverage is liability, which pays for damages to another person's vehicle and their medical expenses if you are at fault. Other common types of coverage include collision, which pays for damage to your own car from an accident, and comprehensive, which covers non-accident related damage, like from theft, fire, or a storm. Similar to protecting your car, you also need to protect your living space. This is where homeowners and renters insurance come in. If you own a home, your mortgage lender will require you to have homeowners insurance. It covers damage to the structure of your home and your personal belongings inside it. If you rent, renter's insurance is an affordable and highly recommended policy that covers your personal possessions, like furniture, electronics, and clothing, in case of theft, fire, or other disasters. Both types of policies also include crucial liability protection, which can cover legal costs and medical expenses if someone is injured on your property. Now let's discuss a topic that can be difficult to think about, but is vital for anyone who has dependents: life insurance. The fundamental purpose of life insurance is to provide a sum of money to your chosen beneficiaries to replace your income and help them financially after you pass away. This money can be used to pay off a mortgage, cover daily living expenses, or fund a child's education. There are two main categories of life insurance. Term life insurance provides coverage for a specific period, or term, such as 10, 20, or 30 years. It is often described as pure insurance protection. Permanent life insurance, which includes types like whole life, provides lifelong coverage and also includes a savings or investment component that can grow in value over time. These two types serve different needs and have very different cost structures. The decision of what type and how much life insurance is appropriate is a significant financial choice. Finally, there is one of the most overlooked, yet most important types of insurance: disability insurance. Many people think of it as income protection. Its purpose is to replace a portion of your monthly income if you become seriously ill or injured and are unable to work for an extended period. Your ability to earn an income is your most valuable financial asset. Disability insurance is the tool that protects that asset. It ensures that you can continue to pay your bills and manage your expenses even if you cannot work. In conclusion, insurance is a cornerstone of a sound financial plan. It is the defensive strategy that protects your offensive strategy of saving and investing. By understanding the purpose of health, auto, home, life, and disability insurance, you can better appreciate their role in providing security and peace of mind. We've spent time protecting our assets and our income. Now let's turn to how we can invest in the future, specifically by planning for one of the most significant expenses many families will face: the cost of higher education. In our next chapter, we'll explore strategies and accounts designed for saving for college. Thank you for listening. Hello and welcome back. So far in our series, we have focused on building and protecting your personal financial world. We've discussed everything from daily budgets to long-term retirement planning. Today, we're going to address another major long-term goal that many American families face: saving for the cost of higher education. It's no secret that the cost of college has risen significantly over the past few decades. For many, it's one of the largest expenses they will ever plan for, right alongside buying a home and saving for retirement. The prospect of paying for a college education can feel overwhelming, but like any large financial goal, it becomes much more manageable when you have a plan and start early. The power of compound growth, which we discussed in our retirement chapter, is just as critical when saving for education. To encourage families to save for these costs, there are specific types of savings and investment accounts that offer powerful tax advantages. Much like a 401k or an IRA is a special container for retirement savings, these accounts are special containers designed for education savings. Let's explore the most common of these tools. The most popular and widely used vehicle for college savings is the 529 plan. Named after the section of the tax code that created them, 529 plans are investment accounts sponsored by individual states or educational institutions. While they are state-sponsored, you are generally not restricted to using your own state's plan. You can enroll in almost any 529 plan across the country. The primary benefit of a 529 plan is its tax treatment. While your contributions are typically not deductible on your federal tax return, your money grows tax-deferred. The biggest advantage comes when you withdraw the money. Withdrawals for qualified higher education expenses are completely free from federal income tax. Many states also offer a state income tax deduction or credit for contributions made to their specific plan, which can be an added benefit. So what is a qualified expense? This generally includes tuition and fees, room and board, books and supplies, and required equipment like computers. The rules for these plans have become more flexible over time, with some provisions now allowing funds to be used for K-12 private school tuition or to pay back a certain amount of student loan debt. The regulations can and do change, so it's always a good idea to look up the current rules. In a 529 plan, an adult, often a parent or grandparent, opens the account and acts as the owner, naming a child as the beneficiary. The account owner maintains control of the funds and decides how the money is invested and when it is withdrawn. If the original beneficiary decides not to go to college, the owner can typically change the beneficiary to another eligible family member. Inside the plan, you'll usually find a range of investment options, often consisting of mutual funds. Many plans offer age-based or target date portfolios. These automatically adjust their investment mix over time, typically starting with a more aggressive, growth-oriented strategy when the child is young and gradually shifting to a more conservative, capital preservation strategy as the child gets closer to college age. While the 529 plan is the most prominent tool, there are other options to be aware of. One is the Coverdell Education Savings Account, or ESA. Like a 529, a Coverdell ESA allows for tax-free growth and tax-free withdrawals for qualified education expenses. However, it has some key differences. There are income limitations on who can contribute, and the total annual contribution amount is much lower than that of a 529 plan. A notable feature of the Coverdell is its flexibility, as funds can be used for qualified K-12 expenses in addition to higher education costs. Another type of account you may hear about is a custodial account, known as an UGMA or UTMA account. These are not specifically education accounts. When you put money into a custodial account, you are making an irrevocable gift to a minor. The key difference is that once the child reaches the age of majority in their state, usually 18 or 21, the money becomes their legal property, and they have full control over it. It's also important to briefly touch on financial aid. The amount of money a student can receive in need-based financial aid is determined by a formula that considers the income and assets of both the parents and the student. Savings in accounts like 529s and custodial accounts can impact eligibility. Generally, funds in a parent-owned 529 plan are assessed at a much lower rate in the financial aid formula compared to assets held in a custodial UGMA or UTMA account, which are considered the student's asset. This is a factor that many families consider when choosing a savings strategy. In summary, planning for education is a significant undertaking where starting early is your greatest advantage. Tax-advantaged accounts, especially 529 plans, are powerful tools designed specifically to help you meet this goal by allowing your savings to grow and be withdrawn tax-free for qualified expenses. We've now talked about several accounts, from IRAs to 529s, that have special tax rules. This highlights just how intertwined our financial lives are with the tax system. In our next chapter, we will demystify the basics of the U.S. income tax system to help you understand how it works. Thank you for listening. Hello and welcome back. In our recent chapters, we've discussed a number of financial tools, from retirement accounts to college savings plans, that come with special tax rules. This is no accident. The U.S. tax system is deeply intertwined with our personal finances. While it can seem incredibly complex, having a basic understanding of how it works is essential for making informed financial decisions. Before we go any further, it is critical to state this very clearly. This chapter is for informational and educational purposes only. It is a simplified, high-level overview and is absolutely not tax advice. Tax laws are complex, they change frequently, and your personal situation has unique factors. For specific guidance, you should always consult with a qualified tax professional, such as a CPA or an enrolled agent, or use reputable tax software. At its core, the income tax system is the primary way the federal government funds its operations, everything from roads and bridges to national defense and social programs. As a citizen or resident, you are required to report your income to the Internal Revenue Service, or IRS, and pay tax on that income according to a set of rules. To understand how your tax is calculated, it's helpful to think of it as a step-by-step process of reducing your total income down to the amount that is actually taxed. The process starts with your gross income. This is, in simple terms, all the money you earn in a year from all sources. This includes your salary and wages from a job, income from a side business or freelance work, tips, investment earnings, interest from a savings account, and other sources. From your gross income, you subtract certain specific adjustments to arrive at a very important number: your adjusted gross income, or AGI. These adjustments, sometimes called above-the-line deductions, might include things like contributions to a traditional IRA, certain student loan interest paid, or contributions to a health savings account. Your AGI is a key figure used to determine your eligibility for various tax benefits. The next step is to subtract deductions. This is where you have a choice to make. You can either take the standard deduction, or you can itemize deductions. You cannot do both. The standard deduction is a fixed dollar amount, determined by Congress, that you can subtract from your AGI. The amount depends on your filing status, whether you are single, married, filing jointly, and so on. It is designed to be a simple, straightforward way to reduce your taxable income. Alternatively, you can itemize deductions. This means you add up a list of specific, eligible expenses. Common itemized deductions can include things like mortgage interest on a home, state and local taxes, up to a certain limit, and charitable contributions. A person will typically choose whichever option, standard or itemized, results in a larger deduction, and therefore a lower tax bill. After you subtract your chosen deduction from your AGI, you are left with your taxable income. This is the final amount of your income that is actually subject to tax. Now, how is the tax itself calculated? The U.S. uses a progressive tax system with marginal tax brackets. This is a widely misunderstood concept. It does not mean that all of your income is taxed at your highest brackets rate. Think of it like filling a series of buckets. The first bucket, representing the lowest tax bracket, gets filled with your first dollars of taxable income, and is taxed at that low rate. Once that bucket is full, any additional income spills over into the next bucket, which is taxed at the next highest rate, and so on. Your marginal tax rate is simply the rate you pay on your very last dollar of income, the rate for the highest bucket your income reaches. Finally, it's crucial to understand the difference between a tax deduction and a tax credit. A tax deduction, as we've discussed, reduces your taxable income. The value of that deduction depends on your marginal tax bracket. A tax credit, however, is a dollar-for-dollar reduction of your actual tax bill. A $1,000 tax credit reduces your tax bill by $1,000. For this reason, a tax credit is generally more valuable than a tax deduction of the same amount. There are many different tax credits, designed to benefit families, students, and savers, each with its own set of specific rules. To summarize, the U.S. tax system calculates your tax bill through a process of refining your income, from gross income, to adjusted gross income, to your final taxable income after deductions. That income is then taxed using a progressive, marginal bracket system. The final bill can then be reduced by any tax credits for which you are eligible. Understanding the flow of money for taxes is a crucial skill. But what about planning for the flow of your assets to the next generation? This involves another area of financial planning with its own set of rules and important considerations. In our next chapter, we will introduce the basics of estate planning. Thank you for listening. Hello and welcome back. Over the course of this series, we have meticulously covered the building blocks of a sound financial life, from managing daily cash flow to planning for long-term goals like retirement. Today, we're going to address a topic that is fundamental to a truly comprehensive financial plan, yet one that many people put off: estate planning. Let's begin with a crucial disclaimer. Estate planning is a complex area of the law that intersects with your personal finances. The information in this chapter is for educational and informational purposes only. It is a general overview and is not, and should not be considered, legal or financial advice. State laws vary significantly, and your personal circumstances require personalized guidance. It is absolutely essential to consult with a qualified attorney who specializes in estate planning to create a plan that is right for you. So what is estate planning? Many people think it's just about deciding who gets your property after you die. While that is a major part of it, a complete estate plan also addresses another critical question: who will make decisions for you if you become unable to make them for yourself due to an illness or injury? At its heart, estate planning is the process of creating a clear set of instructions to ensure your wishes regarding your property and your personal care are carried out, no matter what happens. Let's talk about the common documents that are often the core components of an estate plan. The most well-known document is the last will and testament, or simply a will. A will is a legal document in which you state your wishes for how your property should be distributed after your death. In it, you can name an executor, who is the person or institution you trust to be in charge of carrying out your will's instructions. For parents of young children, a will is also the primary place to nominate a guardian to care for them. After a person passes away, a will typically goes through a court-supervised process called probate, where its validity is confirmed and the executor is formally given the authority to manage the estate. Another powerful tool you will often hear about is a trust. A trust is a legal arrangement where a person, the trustee, holds and manages assets for the benefit of another person, the beneficiary. One common type is a revocable living trust, which you create during your lifetime. You can place assets like your home or investment accounts into the trust, and you can typically act as your own trustee, maintaining full control. A key feature of a living trust is that assets held within it can often pass to your beneficiaries upon your death without going through the public probate process. This can sometimes offer more privacy and a faster distribution of assets. Trusts can be structured in many complex ways to achieve various goals. Next, let's discuss planning for incapacity. This is where powers of attorney come in. A durable power of attorney for finances is a legal document where you name a person, often called an agent, to manage your financial and legal affairs if you become unable to do so. This person can pay bills, manage investments, and handle other financial matters on your behalf. The durable part is key, as it means the document remains in effect even after you become incapacitated. Similarly, an advance healthcare directive addresses your medical wishes. This is often a two-part document. The first part is a living will, where you can state your preferences for end-of-life medical care.
Disclaimer: the information presented is for informational purposes only, and is not professional financial, investment, or tax advice. All investments involve risk, and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided,
such as the use of life support. The second part is a healthcare power of attorney or healthcare proxy. In this document, you name an agent to make medical decisions for you if you are unconscious or otherwise unable to communicate your wishes. These documents are designed to ensure your medical treatment aligns with your values. Finally, there is a simple yet critically important aspect of estate planning that is often overlooked: beneficiary designations. Many financial accounts such as 401(k)s, IRAs, and life insurance policies allow you to name a beneficiary directly on the account. When you pass away, the money in these accounts goes directly to the person you have named, bypassing both the will and the probate process. It is a powerful and direct way to transfer assets. It is also crucial to review these designations regularly, especially after major life events like a marriage, divorce, or the birth of a child, to ensure they are up to date and reflect your current wishes. In summary, estate planning is about much more than just money. It's about providing for your loved ones, ensuring your personal and medical wishes are honored, and creating an orderly transition for your affairs. Having a plan in place is one of the most thoughtful things you can do for your family, giving them clarity and peace of mind during a difficult time. We've now covered many of the technical building blocks of finance, from budgeting to estate planning. But a financial plan is only as good as our ability to stick with it. In our next chapter, we'll explore the fascinating intersection of psychology and money, and discuss common financial mistakes and how to avoid them. Thank you for listening. Hello and welcome back. In our journey together, we have covered the essential mechanics of personal finance, the what to do, and the how to do it. We've discussed budgeting, saving, investing, and planning for major life goals. But today, we're going to explore what is often the biggest variable in any financial plan: the human element. We're going to talk about the intersection of psychology and money. A financial plan is only as good as our ability to stick with it, and our brains are wired with mental shortcuts and emotional responses that, while helpful in other areas of life, can lead to costly errors when it comes to money. Understanding these common psychological traps is the first step toward making more rational and successful financial decisions. As always, this chapter is for educational purposes to help you build self-awareness, and is not financial or psychological advice. Let's explore some of the most common behavioral biases that can impact our finances. First is overconfidence bias. This is the tendency for people to be more confident in their own abilities and knowledge than is objectively reasonable. In finance, this can manifest as someone believing they can consistently pick winning stocks, or time the market perfectly, buying at the lows and selling at the highs. This overconfidence can lead to excessive trading, which racks up fees, and a lack of diversification, which increases risk. The reality is that even the most seasoned professionals find it nearly impossible to time the market consistently. Next is a powerful emotional bias called loss aversion. Psychologically, the pain of losing is felt much more intensely than the pleasure of an equivalent gain. For most people, losing $100 feels much worse than gaining $100 feels good. This can cause two distinct problems. First, it can lead investors to hold on to a losing investment for far too long, hoping it will break even, because selling it would mean formally acknowledging or realizing the loss. Second, it can make people overly conservative, causing them to avoid investing altogether for fear of any potential downturn, thereby missing out on long-term growth. Then there is the powerful influence of herd mentality. As social creatures, we are wired to follow the crowd. We assume that if a large group of people is doing something, they must know something we don't. In the financial world, this can be incredibly dangerous. It's what fuels speculative bubbles, where people pile into a hot asset class simply because its price is going up and everyone else is buying it. It also drives market panic, where people sell their investments during a downturn just because they see others doing the same and read fearful headlines in the news. Herd mentality often causes people to buy high and sell low, the exact opposite of a sound investment strategy. Another common trap is confirmation bias. This is our natural tendency to search for, interpret, and remember information that confirms what we already believe. If you've decided a particular investment is a great idea, confirmation bias will lead you to seek out articles and opinions that support your decision, while subconsciously dismissing or ignoring any evidence that contradicts it. This creates an echo chamber that reinforces your initial view, preventing a balanced and objective assessment of the risks. Finally, let's touch on recency bias. This is the tendency to give too much importance to recent events when making predictions about the future. If the stock market has had a fantastic year, recency bias might lead you to believe it will continue to go up indefinitely, causing you to take on more risk than is appropriate. Conversely, after a market crash, recency bias can make you believe that the market will never recover, causing you to sell at the bottom or stay out of the market for too long. So, knowing that these biases exist, what are some general strategies to counteract them? The first is to create a system and automate it. One of the most effective ways to overcome emotional decision-making is to remove the decisions themselves. Automating your savings and your investments, such as through automatic 401k contributions or transfers to your savings account, ensures that you are acting consistently, regardless of how you feel or what the market is doing on any given day. Second, have a written financial plan. A clear, long-term plan acts as your anchor in a sea of emotional noise. When you are tempted to make a rash decision based on fear or greed, you can return to your written plan and remind yourself of your long-term goals. Third, practice a cooling-off period. Before making any significant non-emergency financial move, commit to waiting for a set period, like 24 or 48 hours. This simple delay can allow the initial emotional impulse to fade, enabling you to approach the decision with a clearer, more logical mind. In summary, our minds are not always wired for optimal financial decision-making. By being aware of common biases like overconfidence, loss aversion, and herd mentality, we can begin to recognize them in ourselves and create systems to foster discipline, patience, and a long-term perspective. We've learned how our own minds can be a financial hurdle. But what about external hurdles? The financial world is, unfortunately, home to scams and fraudulent schemes designed to prey on these very psychological triggers. In our next chapter, we will discuss how to recognize and protect yourself from common financial scams. Thank you for listening. Hello and welcome back. In our last chapter, we explored the internal threats to our financial well-being, the psychological biases that can lead us to make mistakes. Today, we are turning our attention outward to focus on the external threats, the world of financial scams and fraud. In our connected digital age, it has become easier than ever for dishonest people to try and gain access to your money and your personal information. Their methods are constantly evolving and can be incredibly sophisticated. But while their tactics may change, their underlying strategy does not. Scammers work by exploiting the same human emotions and psychological triggers we discussed in the last chapter. Your best defense against them is not a complicated piece of software, but a powerful and well-informed mindset. This chapter is designed to raise your awareness of common scams and provide general knowledge to help you stay safe. If you ever believe you have been a victim of a scam, you should contact your local law enforcement and can file a report with the Federal Trade Commission, or FTC. Scammers are masters of emotional manipulation. They try to get you into a state where you are not thinking logically. They do this by creating a sense of urgency. You'll see phrases like "act now" or "immediate action required." They want you to feel pressured to make a decision before you have time to think. They also use fear. You might get a threatening phone call from someone pretending to be from the IRS, claiming you owe back taxes, and will be arrested if you don't pay immediately. Or they might send a pop-up on your computer screen with a loud alarm, claiming you have a virus that will delete all your files unless you call a fake tech support number right away. And on the other end of the spectrum, they exploit hope and greed. This is the territory of the too good to be true offer. You might receive an email telling you you've won a foreign lottery you never entered, or get a message about a secret investment that is guaranteed to produce massive returns with zero risk. They prey on the universal desire for an easy financial win. Let's identify some of the most common types of scams you might encounter. One of the most prevalent is phishing. This is when you receive a fraudulent email, text message, or social media message that is designed to look like it came from a legitimate source, like your bank, a shipping company, or a popular online store. The message will often contain a link that, when clicked, takes you to a fake website that looks just like the real one. The goal is to trick you into entering your username, password, credit card number, or other sensitive information. Another is the imposter scam. This is when a scammer pretends to be someone you know or trust. We've already mentioned the fake IRS agent. Another classic version is the grandparent scam, where a scammer calls an older person, pretending to be their grandchild who is in trouble and desperately needs money wired to them immediately. They will often beg you to please don't tell mom and dad. You should also be wary of investment scams. These schemes promise high returns with little to no risk. Remember the fundamental principle of investing. Risk and potential return are related. Any offer of a guaranteed, high return is a massive red flag. These scams often involve pressure to invest right away, and may have the characteristics of a Ponzi or pyramid scheme, where money from new investors is used to pay off earlier ones. So, how can you build your digital shield and protect yourself? Here are some core principles. First, and most importantly, slow down. Scammers want you to act before you can think. If you receive an unexpected and urgent request, the single best thing you can do is take a breath and pause. A legitimate organization will not pressure you into making an immediate, on-the-spot decision. Second, verify independently. Never, ever click on links in a suspicious email, or call the phone number left in a voicemail. If you get an email from your bank about a problem with your account, do not engage with it. Instead, close the email and contact your bank using the phone number on the back of your debit card, or by typing their official website address directly into your browser. Third, be skeptical of unsolicited contact. If you receive an offer or a warning out of the blue, ask yourself, why? Why would a foreign prince need your help to move money? Why were you selected for a prize in a contest you never entered? A healthy dose of skepticism is your best friend. Fourth, know that legitimate organizations will never demand payment in unconventional ways. No government agency like the IRS, or a legitimate company like Microsoft or Apple, will ever demand that you pay a fee using gift cards, a wire transfer, or cryptocurrency. Scammers demand these payment methods because they are difficult to trace and nearly impossible to reverse. This is one of the biggest red flags of all. Finally, protect your personal information. Treat your social security number, online passwords, and bank account numbers as if they were cash. Use strong, unique passwords for your financial accounts, and be cautious about what you share online. By understanding the psychology that scammers use and recognizing their common tactics, you can become a much harder target and keep your financial foundation secure. Protecting ourselves from external threats is critical. But how do we measure our progress and tie all of these financial concepts together? Many people look to major financial goals as a benchmark. In our next chapter, we will discuss the process of setting and achieving meaningful financial goals. Thank you for listening. Hello and welcome back. In our last few chapters, we've focused on defense, understanding our own psychological biases, and protecting ourselves from external scams. Today, we return to the inspiring and forward-looking part of personal finance. We're going to talk about the engine that drives your entire financial plan. Setting clear and meaningful goals. Think of it this way. A budget tells you what you can do with your money. A savings account is a place to put it. An investment is a tool to grow it. But without a goal, these are just tools without a purpose. Financial goals are what give your efforts direction. They are the why behind your decision to save instead of spend, or to invest for the long term instead of seeking short-term gratification. They transform the abstract process of managing money into the exciting journey of building the life you truly want. A solid financial plan is not just about one goal, but a combination of goals with different timelines. It's helpful to categorize your goals into three main buckets: short-term, mid-term, and long-term. This helps you choose the right savings or investment strategy for each. Short-term goals are typically those you want to achieve within the next 1 to 3 years. These are often for specific, tangible objectives. Examples include saving up for a major vacation, paying off a lingering credit card balance, buying a new piece of furniture, or building your starter emergency fund. Because the time horizon is short, the money for these goals is often kept in safe, liquid, and easily accessible accounts, like a high-yield savings account. You don't have enough time to risk a potential market downturn. So the priority is preserving the money you've saved. Mid-term goals usually have a time frame of about 3 to 10 years. These are often for major life events that require more significant capital. The most classic example is saving for a down payment on a home. Other midterm goals might include saving to start a business, planning for a wedding, or setting aside money for a new car. The strategy for these goals can be more varied. Depending on the exact timeline and a person's individual comfort with risk, the funds might be kept in a mix of safe accounts and more conservative investments. Finally, there are your long-term goals, which are 10 years or more into the future. These are the huge milestones that define your financial life. The two most common long-term goals are saving for retirement, and for those with children, saving for their college education. Because you have a long time horizon, these goals are typically pursued through investment accounts, like the 401k, IRAs, and 529 plans we've discussed. The long time frame gives your investments the potential to benefit from compound growth, and allows you the time to recover from the inevitable ups and downs of the market. Simply having a list of goals is a good start, but to make them powerful, they need to be well defined. A widely used and highly effective framework for setting goals is the SMART acronym. Let's break down what it means. S stands for specific. A vague goal like, I want to save more money, is hard to act on. A specific goal is, I want to save $5,000 for a trip to the national parks. It gives you a clear target. M is for measurable. You need to be able to track your progress. This is why putting a number on your goal is so important. $5,000 is measurable. You know exactly how much you need and how far along you are at any given time. A is for achievable. Your goal must be realistic. While it's great to dream big, setting a goal that is impossible to reach given your current income and expenses can lead to frustration and cause you to give up. The goal should stretch you, but not break you. R stands for relevant. This is perhaps the most important letter. Does this goal actually matter to you? Does it align with your personal values and what you want out of life? A goal that is deeply relevant to you will provide its own motivation. Saving for a down payment will feel more meaningful if homeownership is a genuine dream of yours. And finally, T is for time-bound. Your goal needs a deadline. I want to save $5,000 for a trip to the national parks in 24 months. Giving your goal a timeline creates a sense of urgency and allows you to break it down into manageable steps. Let's see how this all comes together. With our SMART goal of saving $5,000 in 24 months, you can now calculate your path forward. You know you need to save approximately $208 per month. The next step is to go back to your budget, which we created in Chapter 1, and identify where that $208 will come from. Once you've found it, you can use the strategy of automation we discussed in Chapter 12 and set up a recurring, automatic transfer from your checking account to a dedicated savings account. This is how a vague hope is transformed into an actionable, automated plan. In summary, goals are the heartbeat of your financial plan. By categorizing them by time and defining them using the SMART framework, you create a clear, motivating, and personalized roadmap for your financial future. Over the past 14 chapters, we have covered an immense amount of ground, from the nuts and bolts of budgeting to the high-level concepts of estate planning. In our final chapter, we will bring everything together. We'll review the key pillars of financial wellness and discuss how to build a sustainable, lifelong habit of financial management. Hello, and welcome back for our final chapter. For the past 14 chapters, we have embarked on a comprehensive journey through the world of personal finance. We started with the most basic question: where do I begin? And have since navigated everything from debt and credit to investing, insurance, and estate planning. If you've been with us the whole way, you now have a complete framework for thinking about and managing your financial life. The goal of this final chapter is not to introduce a new topic, but to bring everything together. This isn't an end, but a beginning. We're going to review the core pillars of financial wellness and discuss the most important topic of all: how to transform this knowledge into a sustainable, lifelong habit. As we've seen, a healthy financial life is built upon a few key pillars. The first pillar is awareness. This is the foundation we laid in Chapter 1. It is the commitment to know with honesty and clarity exactly where you stand. This means understanding your net worth, and most importantly, tracking your cash flow through a budget or spending plan. You cannot manage what you do not measure, and awareness is the essential first step that makes all others possible. The second pillar is control. This is about mastering your financial obligations and reputation. We covered this when we discussed creating a strategy to manage and reduce debt, and when we demystified the power of your credit score. Taking control means you are no longer a passive participant, but the active director of your financial story. The third pillar is security. This is your defense system. It is the peace of mind that comes from having an emergency fund to absorb life's unexpected shocks. It is the protective shield of having the right types of insurance to guard against catastrophic loss. And it is the digital shield of being aware of financial scams to protect what you have built. The fourth pillar is growth. With your foundation secure, you can focus on building for the future. This is the pillar of long-term, goal-oriented saving and investing. It's powered by understanding the magic of compound growth, and by setting SMART goals for the major milestones you want to achieve, whether that's retirement, homeownership, or a child's education. And the final pillar is knowledge. This is your commitment to being an informed steward of your own finances. It means understanding the basics of how the tax system works, as well as the fundamental concepts of estate planning to provide for your loved ones. It's about knowing enough to ask the right questions. Underpinning all of these pillars is your mindset. As we learned, our own psychology can be our biggest asset or our biggest liability. A successful financial life requires cultivating patience, discipline, and a long-term perspective that can tune out the short-term noise and emotional temptations. Knowing all this is one thing. Putting it into practice consistently is another. So how do you make financial management a lasting habit? First, start small. You do not have to tackle everything at once. The sheer volume of information can be paralyzing. Instead, pick one single manageable action. Perhaps it's calculating your net worth for the first time. Or maybe it's setting up an automatic transfer of just $25 into a savings account. Small, consistent wins build momentum and confidence. Second, automate everything you can. This is perhaps the single most effective strategy for building good financial habits. Set up automatic contributions to your retirement and savings accounts. Use automatic bill pay to ensure you're never late. Automation puts your financial plan on autopilot, executing your intentions in the background without relying on your daily willpower. Third, schedule regular financial check-ins. You don't need to check your finances every day, but you should check in regularly. This could be a 30-minute review of your budget every month, or a more in-depth, annual meeting with yourself or your partner to review your goals, net worth, and overall strategy. This turns financial management from a stressful, reactive event into a calm, proactive habit. And finally, embrace imperfection and grant yourself grace. You will have months where you overspend. You will make financial mistakes. Everyone does. The goal is not perfection, it is persistence. Acknowledge the misstep, learn from it, and get right back on track with your plan. It is the long-term consistency that builds wealth, not short-term perfection. Our goal throughout this entire series was never to give you all the answers. It was to empower you with the foundational knowledge to find the answers for yourself, and to have more informed conversations. As we close, we will leave you with our most important reminder, one last time. This series has been for educational and informational purposes only. It is not and should not be taken as personal financial, investment, legal, or tax advice. Your life is unique, and you deserve guidance tailored to your specific circumstances. We strongly encourage you to seek out and build a team of qualified, licensed professionals to help you navigate your journey. The path to financial wellness is not a destination you arrive at, but a continuous journey of learning and growth. You now have the map and the compass. The next step is up to you. Thank you for joining us. We wish you the very best in building a secure, prosperous, and fulfilling future.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.